Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 10th, 2022. It is 2:41 p.m. Eastern Time as I'm starting the video, so a little over an hour to go in the trading session. And in the video I did earlier today, I told you I was going to break them down, and I wanted to cover fixed income in this one, and that's going to be government bonds, corporate bonds, both high yield, investment grade. And we'll look at muni bonds, and because for a potential trade or investment ideas, and also the fact that corporate, or not just corporate and treasury bonds together can often give you some clues on as to what the stock market may or may not do. So that's the takeaway there. So even if you don't trade bonds, you might want to keep an eye on them. I'm going to squeeze Bitcoin in here because I haven't covered it lately. If you've been with the site for a while, you know that over the years I've posted a lot of trade ideas on Bitcoin called some big tops and bottoms. It trades so well to the technicals, at least my style, and that's because there are no fundamentals to Bitcoin. It doesn't have earnings. It doesn't do quarterly earnings reports and conference calls. It doesn't do share buybacks, share price dilution, stock splits, any of that nonsense. So those are all fundamental things that stocks have. So basically, the charts are going to be your best guide for Bitcoin. Now I'm going to just tell you where we're at here. This is a daily chart. Fundamentally, I'm just trying to stay clear of it because I think we're in a very political driven environment. Yesterday, there's a whole thing Biden administration is going to look into, study cryptos and, more buzz about maybe the U.S. offering their own form of cryptocurrency. That to me is all noise. That stuff's been around for a while. It was in the headlines yesterday. But let me just show you. I haven't been trading Bitcoin lately because it's just not. I'm not feeling it, and I also can tell you that a little concerned. Government has gotten bigger and bigger and bigger in their reach in recent years, especially U.S. government, and I put nothing above them. And we know this. We know that they've got hard, strict sanctions on Russia now. Ruble's collapsing. The Russian stock market's frozen up, and so it's doubted that there's a huge amount, I'm sure, of money that's moved into Bitcoin to try to, look for a flight to safety. Anyway, it wouldn't surprise me if the government doesn't go after this. And besides that, Bitcoin is a threat to our own sovereign, our own fiat currencies, not just the U.S., all the global central banks. The only way out of all the money printing they've done in recent years is to pretty much devalue that currency via more bond issuance and other shenanigans they do to, finance these huge deficits. But anyway, so they can't afford this. And one day, sooner or later, they're probably going to kill that to whatever extent they can. I don't know. I'm not an expert in crypto, but I am consider myself somewhat of an expert in the charts. So let's dig into that. All right, these futures roll, and this one's going to roll soon. These are the March. Next time I update this, we'll probably be off the March contracts and rolled over. But there was a big bearish rising wedge pointed out at the time. Negative divergence. Beautiful textbook. Boom. Breakdown, back test. Correction ended with a bullish falling wedge at support. Went up here and just look for these divergent highs, divergent lows. This is, I don't want to really make, over simplify it here, but it's kind of simple stuff. Divergent highs, divergent low, divergent high, divergent low. Oh no, that was just a correction back to support. I don't have all the levels marked here. That was support. Again, these futures roll, and I'll update the charts from time to time. That one was updated back then. And then most recently back here, late last year, I pointed out this bearish rising wedge. Broke, gave us a sell signal, moved down. And then I was updating it here, and here's what I told you guys, and I'll still maintain. I'd be very interested, not that it has to get there, but this is where, and I said it months ago, and it still holds true. I pointed out this trend line, and I said a break of that trend line it could run, and it popped, but it also went down, back tested. So here's the levels in a nutshell, and these are, gosh, if I didn't say it, guys, BRR is Bitcoin futures. That's what I like to. I don't trust Coinbase. I don't know Coinbase. Nothing against them. I personally keep my money at brokers with, stocks, bonds, futures, things that are SIPC insured. Your broker fails, SIPC will come in, and they don't. It's not the same kind of insurance where if you plunk $100,000 in Bitcoin and it craps out and drops 90%, they don't reimburse those losses. They reimburse you if your broker fails, and all of a sudden you pick up the phone and Interactive Brokers is out of business, and that's where SIPC's going to step in and replace your securities. And then they also have private coverage in addition to that, most brokers. Anyway, so that's there. This is the big picture, and it's also a at least a year-long topping or consolidation pattern. It could be topping, or it could break out and head to the upside. This one, I don't know. It hasn't been around long enough to have long-term, like monthly charts and weekly charts that go back far enough. So this is what I'm looking at. So I'm just going to read you the levels and move on. 45, 196. And again, when they roll, these lines may change, the levels may change a little. If it can pop that, that is resistance. In other words, 54, 543 would be your next resistance, a potential target, if it can pop above there. Otherwise, I'll tell you what my preferred scenario is, still the same one I gave you back here a few months ago. And that is that we continue on down. And I'm not shorting it down here. It's just where I'd be interested to step in and buy. We move on down, come on down, maybe another back test of the trend line. And then at that point, we could, if we fall, this is a very nice support level. That's one thing I didn't see really great support in here. It was okay support, but if we fall on down and come to that 3,200-ish level there and do it relatively soon, we could have nice positive divergence. And at support, I love buying things that fall to support with bullish divergences in place. So it would look something like that. All right, so if there's and I do these videos in advance in case there's some big market movement news, boom, runs it down there. You take a shot. If it's heading there fast, you got to use a little bit wider stop. If it breaks under and then recovers, you can also go long there if it recovers back above there, and then hold on for a while. That might be a start of a new trend, or because that's a big powerful trading range, it breaks it and then that's bearish if it doesn't recover it. Could be a lot more downside to come. So those are my thoughts. That's a daily chart, daily candles, 3-month chart. Let me just see if I have anything. See, it's kind of noise lately. It's boom, boom, boom. It's moving around. Things are going to hell in a handbasket over in Europe with Russia and Ukraine, but yet you're not seeing that flight to safety that everyone talked about forever. All the millennials were saying gold's done, Bitcoin's the new gold, and blah, 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 blah. For whatever reason, it's just looks like a little EKG here in this trading range. So that's it. If it breaks that trading range to the downside, that's going to be bearish near term. If it breaks it to the upside, bullish. And I know that you all don't trade futures. So you have your GBTC, which was the first to market ETF type instrument. I don't believe technically it's not an ETF. It's similar to an ETN, but I think it can trade at a premium or discount to the actual price of Bitcoin. But it does a pretty good job of tracking it, and I've shared this many times over the years as a trading proxy. We had if you're new to the site, we had to give you a sell signal there. First target zone, second, third. We hit my third target perfectly. And at which point that was the final target, so I said cover your short and or go long. Then it hit it again. I said another long entry. I give you targets. We hit all those targets. Right here we shorted it. These were all trades posted on the site. Covered it there. Final target again hit. I didn't remove any, and it went up. And then that's the last time I told you to short it there. We had double top there, divergent high at resistance, and I think on the futures we had a little wedge break there. And boom, boom, boom. That brings us to where we're at. And so this is similar to that chart. I mean, it's the same, it's Bitcoin. It's just not the actual coin or, cryptocurrency or whatever it is. It's the ETF type instrument. And that's it. That's pretty big support there on there. But if we break that, then we'll probably come down. I put a higher weighting on those futures than I do this one. But sometimes it's a case of the tail wagging the dog. If you have a lot of inflows and outflows into these ETF type instruments, it can dictate where it goes. But there's that trading range you're in. So it's noise unless we break. If we break down, I'll look for that divergent low on the futures as well as here on GBTC. I'll look for that as well. There's potential divergence. See how the PPO is making a higher high right now. So if we thrust down anytime soon and test or slightly undercut those lows, maybe all the way down here to that 17-ish level, not sure, then it might give us a nice setup, maybe even give us a little wedge type pattern, and that's again where I'd be interested. I don't have, right now, just staying clear of it, but wanted to share that for those of you that want to trade it. All right, and I'm going to cheat. I'm going to squeeze one more in here, and I updated this morning. I've been updating this recently. I just want to point out something going on in crude. So yesterday or last few days, pointing out that divergent high, then the trend line, it broke, and it's been powerful. So biggest drop in crude in a long, long time. And again, technically induced. You can only go up so much so fast. Negative divergence is everything I like to see already. Blah blah blah. Already covered that. However, look what we have here. We have that drop was very impulsive, and then you set up this flagging type action. You broke down, and so far very impulsive. This was support here. I think the last time I showed you about 107, and then you have a reaction there and a reaction there. So it's more of a support zone. So this is, I think, going to do one of two things. Got to be careful. You have positive divergence here. This is a 60-minute chart, hourly chart we're on. I told you before. I gave you a couple, one trend line. I just added a second one. They're down here. So this, if this flag plays out, which I coin toss odds, I'm going to show you something in a second, there could be another drop from where we're at now. Forget about the off the highs so far. What I told you the other day, it had a potential for 20% drop. There could be another, move this line so I can measure, put it where we're at now, and come on down. It could be about another 10% or so drop, and then from there you'd hit support and almost certainly bounce. The flag would have played out. But I want to show you one other thing. These are the April futures right here we're looking at. I'm going to show you short term now. Keep in mind these 5-minute charts, man, they've been printing money lately. It's a lot of equity markets, crude. It just gives you the little zigs and zags. And listen, when you're in a very high volatile period of volatility, that is, things are moving up and down. The stock market's swinging back and forth, up 3 and down 3, sometimes 6% ranges from high to low in a day, just in the Nasdaq 100, things like that. Then you go and look at crude, natural gas. You're talking 10, 15, sometimes 20% swings, around. And so it doesn't take much. Anyways, I'm showing you this little 5-minute chart. So there's that flag. When that was the flag I showed you on the 60-minute chart with the impulsive leg down. But you do have, and this is why sometimes you get these perfect-looking bear flags, and it's bait. It's bait for the bears. It's bull trap food. And so you have some good support right here. We're hair below it now, but we haven't really started falling like you usually do when you break support. I just want to point out, if you go to that 5-minute chart, look, little bullish falling wedge, positive divergence. So if they pop it, what's going to happen, or what could happen, and it will probably happen, we'll regain that 107-ish support. And if we start to move up, and it starts to become clear to the majority of traders that took this bear flag breakdown that, hey, the flag's not playing out, you could see some short cover and a quick ramp up. This would be your targets, if so. 1550-ish right there, 115, 115.50, and or that intersecting downtrend line, which will come in a little later depending when it gets hit, potential downtrend line. And yeah, it's going to do one or the other. It could do something in between, but how to trade it, just recognize that the flag plays out, it's going to keep going down. So if it pops up here and you take the long, don't get married to it, because if you do, you're looking at another 10 to 12% downside if it pops up a little first. Likewise, you can play that bear flag if you think it's going to play out and hit those trend lines I showed you on the 60-minute chart. Just don't get married to that either. Have your stops relatively tight. Use a nice risk-reward ratio, or stay away. If you're not an aggressive trader, this is not the time to be trading crude oil. It's news driven. The bear flag looks beautiful, but it could be foiled on any headline that comes out right now. We're looking at, futures are rolling right now. A lot of the contracts are rolling over. It's going to lead to volatility, things like that. So, all right, now on to bonds, and I'll try to get those out. I'm going to do a more condensed version than I was originally going to do for you. I know most people listening to my voice don't trade bonds or care about them much, but start out here with the big ones, the government bonds, that is, TLT. Let's take away all the lines. These are levels I've traded and looked at and pointed out. Long opportunities, positive, negative, divergence, swing, swing, swing. Little swing trades. And I told you months ago, for the last several months, more of a bonds right now, if I do trade them and I'm not just using them to kind of gauge where the stock market is going or maybe going, which I do both, I'm in for in and out, hit and run tactical trades. Get in, see little opportunities where you're going to bounce, I like to trade futures, especially bonds, because they're very leveraged up. You're not going to make a lot buying these ETFs unless you put a big, several times what you do in a stock fund, because government bonds, especially government bonds, they don't move much in a day. They're down. TLT's down almost 2%. That's a big day for TLT. And that's where you can take a little more, because you're not going to get clocked on a 10% gap against your position when you wake up in the morning. That's very unlikely unless the markets just crater and there's something crazy going on. So I just wanted to say that. All right, what do I see? What stands out to me? I see pretty good support right here. TLT has fallen to support. It hit it the other day, bounced, and then it went into resistance. These are all levels. I have not touched these lines in here. This one was created back in February, so February 16th, and I haven't updated that. You can see it's been playing well. And look, if you go in real tight, there's a reaction low. I could even do a zone, if you will, support zone. And that's what you see there. Yeah, that support zone runs from 133.16 about 134.70. So that's it. So you had a little false breakout, but it wasn't a false breakout. You rallied and hit resistance. We're bouncing around there. But again, this is pretty big support. So where am I going? Well, if you break it with conviction, then we could be heading a lot lower on TLT. But I'm going to show you a few other charts. Let's look at the weekly before I move off this one. Here's the weekly chart, and again, you can kind of see that support from here. It was support, support, support. Pretty big level. And here's what I want to show you. We have bullish divergence on TLT. I turned the TV on again today. I told you guys, usually I just like to get my news from, written things, online, paper. But lately, things are moving so fast, I find myself turning the TV on more and more to hear what's going on with the economic reports, if there's movement in the markets, because you're going to get, quite often it's going to hit the TV first. They seem, just listening some of the pundits, they're baffled with rates. They think that bond rates, long-term bonds should be going up. They don't understand the bond market. There are a lot of crosswinds. Let me just say that. Keep it very simple. Typically, an inflationary environment will cause interest rates on long-term bonds, TLT, that's the 30-year bond, TNT, the 10, to go up. Because when inflation's high, you expect down the road, you demand a higher rate, a return on your money. But the crosswinds are right now, all the money printing the Fed's done, all the bond purchases they've done, they're trying to unwind that. All these things kind of just really pollute the fundamental outlook and make it extremely hard for analysts that just use fundamental analysis to try to figure out what to do where the bond market's going. Then you also have the whole stagflation theory that I'm working on, and some people more and more are starting to warm up to, where you have inflation in the economy, rising prices, but yet stagnant or even declining economic growth, i.e. a recession or a very slow growth environment. And that's an ugly thing for the financial markets and for most people at the time. So now if that happens, what you could see is rates can go up. Now, okay, we can sit here all day long, just like the analysts are doing, and hash through which one's going to play out. All I can tell you is we're at support. Now, this divergence is not confirmed. PPO is still moving lower, and it could get taken out and burned through. But if it plays out just like it did here, and I pointed that divergent low out to you guys at the time, pointed this out. All this stuff was pointed out that led to that big move up in bonds, divergent high, divergent high. This stuff works. It really does. However, this is unconfirmed and there's no buy signals. You have a trend line here. So what I could see happen, one scenario, if we don't bounce, and if we do, you take a shot here if you at support with a stop somewhat below. But if we break support, the most likely scenario I think then is you have a primary, this is a major trend line right here on TLT. This goes back all the way to the real last bull market, which ended in 2007, right before that bull market ended right there. See, this is what happened to Treasury bonds during the bear market. They shot up, because I always say there's usually a flight to safety risk, just COVID hit. And it's a beautiful trend line. And it also hasn't been visited in a long time. You get a primary uptrend line. Sooner or later you come back and you test it and visit it. So I wanted to say that this is where we could be going. And if we do, hey, that's where I'll be looking to maybe position like 401k type stuff, move into government bonds. might be worth a shot here. We may get there, but it may take a while. This divergence may play out. Let's say here's a possibility as well. We play out, run up here, hit the trend line and that 149 resistance somewhere in there, and then move down. Okay, so I just want to say right now there is a more of a pot shot trade, but it is a falling to support at with positive divergence, which I like to see. All right, I'm going to get to now. Let me do before we move down to the 10-year, and then we'll hit corporates and munis real quick. Long-term stuff. This is important. Every now and then, and for years I've been doing this. I like to paint the big picture of where we are in the interest rate cycle. And the trend on bonds. This is TYX. This is the yield on the 30-year government treasury bond. Okay, that's as long as we issue them now. At one point, I think we used to do 50-year bonds. Some country do, but this is what they call the long bond, and it's a one of the safe havens for institutions. It's a diversification vehicle. It is in a lot of 401k retirement plans have bonds to cushion the blow when they usually go up when stocks go down. And what I want to point out is this is where, when you keep hearing the headlines now, how inflation's at 40+ year highs, well, that was it. Think Jimmy Carter leaving office, Reagan coming in. That's when rates peaked back in the early 80s, right there. And since then, we've been in a very clear and very unmistakable secular bear market in interest rates, which, remember, these are rates, and bond rates and bond prices are inverse to each other. They go up and down. When the rates are falling, bonds are going up, and there's no variation to that formula. It's not, sometimes I talk about the relationship of stocks and bonds, how during stock market corrections or bear market, bonds usually go up. Well, that's not a guaranteed, and it's not a one-to-one relationship. Sometimes it's usually the case, but sometimes things happen where they both trade together. But there is no variation. The interest rate on bonds, especially government bonds, where you have zero default risk, virtually zero, they trade solely on their rates. Corporate bonds are a different animal because there is varying degrees of default risk that can ebb and flow and be priced on the bond. So investment grade corporate bonds tend to trade primarily to their, depending on what their rates or what interest rates are doing. But again, of course, if their credit rating changes, then that's going to impact the price too. All right, so I'm just kind of throwing out there a fast crash course on bonds. But that's it. Make no mistake about it. And also know this, if you're a student of the financial markets, you know the the single most important thing to drive a secular bull market or bear market in stocks, the stock market, is interest rates. So please make no mistake about it. It is not mere coincidence that the stock market, the S&P 500, over the same time we've been in a secular bear market for interest rates, we've been in a secular bull market. This is the stock market going back to that same period, early 80s here. And yeah, you're going to have your corrections. All these are what we call cyclical bear markets, and they're bad. They're not fun to be in if you're long and don't get out. 51% drop, and this is the S&P 500, not the Nasdaq. It was worse back then. 58%. 35, 36 when COVID hit, but they're just cyclical bear markets in an ongoing secular bull, and there's your primary bull market trend line. The bull market trend line I think we're coming back to before all said and done in the next few years here, as we've now embarked on what's almost certainly a turn. And let's not get too far ahead. This is where people don't even want to hear this, but at some point, and probably it maybe happen, we know we hit a bottom on interest rates. We know we hit a bottom. The Fed took them to zero, and they made clear that they would never go to a negative interest rate policy. And even if they did, you're talking it's incremental. It's not negative 10, 15. It's so just to say there is no more downside for interest rates. So that whole thing I just showed you on the 30-year bond, know that this was probably the end to one of the biggest secular bear markets in rates. So best case scenario, they stay low for years to come. And that's still, you don't have this falling rate environment that was bullish for equities. That's best case scenario, that we come back down, stay low. Otherwise, if we begin a new secular bull market in rates, because this inflation is now out of control, the Fed has been, I keep saying the words, maybe I'm a little harsh, critical, I think criminally neglect in their, and how dismissive and just how they completely missed the inflation trade. And to this day, and again, I can forgive and forget. I'm not perfect. I've made some bad calls in the market, bad positions, trades. However, I'll lick my wounds. I'll acknowledge when I'm wrong. To this day, they've done nothing. As I speak, nothing but jawbone and talk. Oh yeah, they've won down the bond program. I'm talking about the rates. They have not raised rates. And in fact, Powell, and this is again, this is why I can't get over this. 2 weeks ago he said, oh, he's only going to, 2 weeks with plenty of time to go, he said he's only going to vote for a quarter-point rate hike. I don't know if they can overpower him. The rest, I don't know how the dynamics work. I know he goes in, he is the boss man, but they all vote, they all give their 2 cents. But to even say that with, as things surge and using Ukraine as an excuse now, what's the next excuse? It's kind of like a spoiled kid when I can't punish him now, this and that. No, you're going to have to take away the punch bowl. And again, at this point, rates should be way, way above where they are. And I think Powell is moving way too slow. And again, yeah, we know we're going to get at least a quarter point coming up because he's pretty much said it. But at this point, it should they could have taken the punch bowl away a year ago or more, when they saw the economy coming back online on fire, when they saw inflation, or at that time surging, when they saw people went back to work. Anyway, I'm just trying to tell you, this is long-term stuff. If you're planning for retirement and all that, well, watch. And look, we're not there now. We're not even close to it. There's my long-term trend lines. I have two of them right there. Start taking out these trend lines, and then we'll talk about being maybe in the early stages of a new secular bull market and interest rates, which again is not going to be good for equities. Right now, we're coming off the bottom, and I will say this, I know the market can certainly tolerate a quarter point, 50 basis points, maybe even a 100-point rate hike, because you're only going from 0 to 1% on the federal funds rate, so it doesn't necessarily have to just put a screaming halt on the market. But the slower the Fed reacts, and the more behind the curve they get, the worse inflation's going to get. And then they risk where things just can get really ugly. Runaway inflation, they're going to be forced to raise at a point where the economy is starting to turn down, because that inflation in itself is going to curtail economic growth. People cannot afford, they can stomach Americans right now. We have it a lot better than Australians and Europeans, a lot better than them on what we pay for gas. And there's going to be a point. It's not a single flash point, but yeah, you start going to $5, $6, $7 a gallon gasoline, milk, whatever milk is, I don't know, I don't do the shopping, it's $5 a gallon for, all these things, and we're seeing that now. That will in itself put the brakes on the economy, but in a much worse way. So all right, that's it. I wanted to say kind of give you the bigger picture here, and then again, looping all back into the shorter term picture. Now look at TYX. Again, we're looking at yields inverse to bonds. Let me show you on the weekly chart. Okay, yeah, this is what I wanted to show you. This is a weekly chart of TYX, again, the 30-year yield. So right now, we're almost to that previous high, and you can see at this point, now remember, the PPO is a momentum indicator. It's still moving higher, but if we turn down soon and make a bearish crossover anytime soon, we're going to have an equal or marginally higher high, and that's going to cause, and I think it's the most likely case, a pullback before we finally get to that longer term trend line. We could head up there, but I think we're looking at probably one more pullback in yields. This is where I differ from most analysts that I'm listening to. They think yields are going to go up because the Fed's going to hike. I see it the opposite. I think they're already behind the curve. They're going to have to start hiking or increasing their hikes in the dot plot, what they're talking about doing, what the street thinks they're going to do. And at the same time, I think we're already going to see, I think enough damage is already being done inflation-wise to the economy. And so therefore, I think the overriding factor is going to be diminished economic expectations, which are going to cause lower rates to fall, which means then bonds go up. So right now I'm making a case that will probably, I'm just giving you my best guess, and that will soon, whether it's starting very soon, we're going to hone down to the short-term charts to help with the timing, but probably get another pullback in bonds, pullback in rates, which means bullish for bonds for a while, and then ultimately another thrust up there to that, to that long-term trend line. Again, that's on the weekly chart. That's the same one, carries over on that monthly chart I gave you, the very long-term primary downtrend line for bonds, which, we were, they were in a normal cycle, but then all these rounds, these are all quantitative. That's the first round right here of quantitative easing. So this is what happened: massive artificial intervention in really a natural rate cycle, and then that was what I called nuclear option. I mean, if you thought, and it was at the time, the biggest intervention in the financial markets in the history of the world back in 2008 when the financial crisis hit, and then they followed up with additional rounds of QE and shenanigans. But again, what they did back when COVID hit, I can only use the word nuclear. It's just unprecedented. Possibly a little head and shoulders going there maybe as well. So, again, so while I think we could get a pullback if these divergences play out, respect a breakout. If it's a solid breakout, and again, we'll watch this and all the other bonds. All right, I'm gonna go too long here if I go forever. Let me just show you TNX drop down. I have a little bit preference right now for TNX. I took a shot today, earlier this morning, into the 10-year Treasury bond futures. Usually I'll trade ZB, that's a 30-year bond, but I did CN, the 10-year. And I'll see. I planned if things go the way I think they might, then I'll add into it. Otherwise, I'll pull the plug if I don't see the charts develop soon. But here's what I'm looking at. This is, again, we're on the rates 10-year TNX, a 10-year Treasury yield. This is a weekly chart, so it's long term. Here's what I'm just going to point out to you. Look, see these divergences down here: positive divergence, negative divergence. Divergent low, rally. Divergent high, correction. Divergent low, rally. Divergent high with a nice bearish rising wedge right here, correction. Little bear flag right there in the middle. See the big move down, bear flag. And now we have this nice bearish rising wedge. You have an uptrend line right here. Big bearish rising wedge with negative divergence at resistance. So this is a potential here. If that wedge breaks down, it's probably going to take us down here. That would be a big drop in yields, which would lead to a pretty big rally in Treasury bonds. All right, so those are the rates, and if you want to trade it, you use futures, or IEF is the 10-year Treasury bond ETF. There's that trend line on the daily chart. Let me show you. Oh no, I'm sorry. This is the weekly chart. The weekly also, you have positive divergence right there, just like you had positive divergence right here, and you had a little wedge there, and the wedge broke out, and that was good for a nice trade, one of the most profitable trend trades in many years right there in IEF. And that ended right here. You had negative divergence on the RSI. So there's your trend line. And again, I'm not super crazy about it because it could take a while to form, or the divergences could be burned out, but there's some support there as well. And so I think it's worth a shot. I like the risk reward. Again, keep stops somewhat tight, relatively speaking. It's a weekly chart. And let me walk it down for you into the daily, show you where we're at here. IEF, 10-year again. There's the support about 110.20. So it really should hold that support and shouldn't go much more, or it'll burn through. But there's positive divergence right there on the daily chart. We already had a breakout right here of this downtrend line, and there's the divergence line breakout, and it's basically a back test here of the support level. So this would be a swing target for you right there, and that would be a move of roughly, from where we're at now, about 4%. And again, if it doesn't sound like much to you, every single contract to ZN is worth $126,094, $126,109 as I speak. That's where I started on a single contract, so I just looked over my account. So, when you make 4%, you're going to make 4,000. If you have 5 contracts, you make 5 times that. Or you leverage up, or you don't trade them if the bonds aren't your thing. All right, let me see here. Oh, sorry for the pause there. Well, that's something I was looking at earlier with Russia, that RSX Russian ETF I was going to talk to you about. There was a big hedge fund that shut down today, a balance fund of all that, and you're going to see more of that. I talked on that a couple weeks ago, how delta hedging works great. That's what a lot of funds will use to protect their downside. Works great when volatility is low, but no longer when volatility starts to spike. So I think you're going to see more and more of that, especially the longer this goes on. If the markets can recover and get back towards the highs and the VIX falls, yeah, we're going to be okay. If not, you're going to see more and more hedge funds either shut down or blow up, and then they have to liquidate. But that's not what I was going for here. I wanted to show you this one, yield chart. This is the US Treasury yield curve. On Guru Focus is the site, and I've talked about this quite a bit, so I'm going to zoom in a little bit for you so you can see it on the video. This is widely considered, and this isn't a little tool or a secret of mine. Everyone knows this, that the yield curve, when it inverts, there you can look at the 10 in 1 year, you can look at the 10-year and 3-year, you can look at the 30-year or 2-year. There's different, but when you look at basically what that means is when the yield, the spread between the 10-year and the 1 year in this case, when it crosses, when it inverts, meaning that the 10-year is then paying you less than the 1 year, that is a yield curve inversion. Usually a yield curve, this is a healthy, normal looking yield curve, and that's where it was back in March of 2020. You want to see, as you normally should be, the longer you tie your money up, the higher the rate. This is a percentage rate you're getting on a bond, up to, well, no, they haven't even paid 3% in a while. And the Fed had the short end down to 0, and you should be rewarded for tying your money up longer. But what happens is, when the yield curve inverts, it's predicting a recession. Bond traders who, no offense to anyone, because I'll put myself in your dumb money crowd with you guys, that's the retail traders, but the professionals are smart money, and they're the ones that trade bonds. Some of them, that's all they do. A lot of them, that's all they do. And so they sniff out, and so when you see long-term rates start to fall and then short-term rates back up, now the Fed's artificially kept this down, capped, but now they're going to be forced to raise, which is going to raise short-term rates, and if I am correct, that's going to stifle economic growth, and it may even, their goal is to pop the inflation trade or put the brakes on it, so that too, diminished expectations are going to invert the yield curve. And we haven't inverted yet, but you can see, usually, healthy economy, you're going up. All the recessions are here shaded in gray. If you can't see it, just go to Focus and get that, or just do a Google search, you'll get yield curve. But you can see, usually once you peak, and look, there was a little stay of execution. That was the last recession. You probably cannot see it in the video. There is a very thin line there. It happened so fast. It's what I called Ursa interruptus, my rough Latin phrase for a bear market interrupted, because the Fed came in with a nuclear option. We went down, we inverted, we were going to head down. It was already priced in, I believe, a couple years ago, a recession. But again, they with a tremendous amount of stimulus that they injected into the system, it's like a dying patient. Let's say you're a battlefield medic and you got somebody comes in and they're just, half their, I don't want to get graphic here, but let's just say, this guy's going out, but you need to know something. You got some intel to tell you, he was on the front line. So what you do, maybe you hit him with a big shot of epinephrine, which is adrenaline, and boom, that patient's going to wake up quick. If you've ever, been hit with a shot of epi, you'll know that's what that'll get you going. That's your adrenaline. Anywho, and so that's what they did. The market gave, but too powerful a shot. It's probably going to kill the patient. Anyways, when we invert, that's it. Without fail, even that last one, which was a blip because the Fed interrupted it and diverted what should have been and what normally would have been a larger recession, it has a 100% effective rate. This is the spread on the 2 to 10 and 2 year, and again, you go back here and it has a 100% effective rate. It inverted there. This was a recession. The gray box is here. I don't know if you can see it. Inverted again, recession came. Inverted here, recession. Inverted here, recession, inverted here, and again, the inversions usually come before an inverted right there, before the drop, before COVID and everything. There was the recession that followed, and again, this predicted it. And now you can guess where we're going. Maybe not. Maybe we've got a little stick save here, but yeah, it's probably coming. Just like here, you can see that. Remember, they tried to stave off that first one. They were briefly successful. But then the bigger one came afterwards, the bigger recession. Again, I don't know if you can see the gray boxes in the video. Okay, I knew this video was going to be long, and I wanted to, and I'll just brush on corporates. There's so much to cover, and because you can really get just as well of a tell on the markets by looking at the corporate bond market. When COVID hit, I was early on. I was ahead of the street on this one. I told you guys we had two shorts on LQD. COVID, the market was falling, but corporate bonds hadn't yet, and I said they were going to crater, and they did, and we shorted it right there. We got a perfect short. We had two short trades on LQD back then. Let me see. I don't know. Yeah, there it is. First one here. There was a beautiful divergent high bearish wedge. The market had already started to roll over, and I already had a short on it, and said that's going to affect the corporate bond market. And especially when COVID started becoming a thing, and it did. Boom, boom. We hit our first target. We got out. Third target. Boom, 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 boom. All three targets. Covered it there, mentioned, likely bounce, and then we reshorted there, and then T1 was hit on the second trade, so we did this. We shorted from here to here, nailed the bottom, got out, and then reshorted back there. It hit the first target, but that's where the Fed stepped in and evoked emergency powers that would allow them to directly intervene in the corporate bond market, buying corporate bonds, junk bonds. And that's what they did, and so they just get a stay of execution for the market. And it worked, and it rallied things up. But now look what we're doing. This is a tell here. LQD is falling hard. What is LQD? I'm sorry, I'm talking so fast. These are investment grade corporate bonds. These are your Apples and Exxon, not Exxon. A lot of the energy stocks are actually, I don't know about ExxonMobil, but a lot of the smaller ones are, in the junk bond arena. Anything that's triple B or higher, anything below triple B rated is junk. I don't want to, again, these videos go so long if I try to go into all the nuances. AAA is the highest rating you can get on a bond. Government bonds are usually, but U.S. government has been downgraded in the past. I don't know if we're still AAA now or what. But and then it goes down the line, AA, single A, triple B, so forth and so on, and then anything below that. And there's different rating agencies that complicate even more, so I can't go into all that. Moody's, AM Best, they all use similar but different, some of the lower ratings. But anyway, to be an LQD, you have to be investment grade. And so what that shows you is a rapid deterioration in corporate fundamentals. Yes, part of this is due, I will say, to expectations of higher rates as well, but LQD has been a great tell on the stock market. I'm going to end it with LQD because I can just tell you junk bonds are also a tell because they're the lowest quality bonds. And what happens as you start to head into before a recession, the bond market is very smart. Lots of money, lots of professional money managers' careers at stake. So they stealthily and not so stealthily. That's what they're doing, but everyone else is watching the stock market go to new highs. And when you start to see junk bonds, the default rate starts going up, the bonds are being sold, credit spreads rise, which is the difference between what a treasury bond and a below investment grade, aka junk bonds, paying. I've watched those. We've seen that tick up recently. And in this case, you have in white LQD, the investment grade corporate bonds, and in green, you have the S&P 500 or SPY. This was 2007. That was our last great bull market, ended in the October of 07. And you can see heading into that, corporates were starting to fall. LQD was going down, and it was a tell that the market peaked there. Then you had a first drop in the stock market, again in green, then a counter trend rally, similar to maybe what's going on now, but then a sharp drop. You can see credit quality was dropping. The smart money knew get out of bonds because those that are triple B today may be double B. And what happens, it's a big whammy. Now, this is what, when we shorted LQD back when COVID first hit, and we got in before, the street, even with professionals, before even the pros knew what was going on. I said, what's going to happen is there's a thing, you got to know how these work. I used to sell bonds for, bond funds, bonds, stocks for a living. Investment grade corporate bonds, LQD, or a mutual fund that holds them, has a thing called a prospectus. The mutual fund prospectus says what the fund manager can and cannot buy. If by prospectus practice, if you run a investment grade quality corporate bond fund, guess what happens if your bonds, any of those bonds get downgraded? You have to sell them. You cannot hold junk bonds. You can't hold a single B-rated bond or a double B-rated bond. Maybe they have a little period of time they can hold it for. And so that's what happened. It was a landslide of bonds that got downgraded. And again, we got in front of that. So that's a tell here. And you're seeing this now. You saw it then, a drop. Then the market's cratered. You saw this was a big Q4, no, I'm sorry, not Q4, to the 2015 sideways market. Two big corrections. Market went sideways for a year. Corporate bonds peaked first. They told a story. Something was going on, and then the stock market followed, and it was almost 2 years before we made it to the peak that we were back here. And then right here, again, peak in LQD, started going down, and then finally, boom, that was that big fourth quarter drop in the fourth quarter of 2018 where the markets fell, depending on which index, about 20% or more. And COVID, it was concurrent. Again, that's where we jumped in ahead of time. They didn't see it. It was a surprise to a lot of professional money managers, although there was already a lot in the charts to be short. And then here it is. So here's corporate bonds. They've been working their way higher. This was kind of a shot across the bow, I think, right there. Corporate bonds came up, and then look, they've been falling since as the stock market continued. This is divergence. This is what I was going at here. You look for this divergence. So the stock market finally peaked here, the S&P 500. And it's been going down. It's been following what corporate bonds have been saying, but now they're falling off a cliff. That's LQD. Bad sign for the stock market. So there's the takeaway. Did they bounce? Sure, they're oversold. They're going to bounce sooner or later. I just don't know when, but you got to be careful. The bottom can fall out for what I just said, how ratings, a sudden shift in the economy, and that's where I differ from just about anybody else I've heard, TV or read. There's other people out there that share similar views I do, but I think what Wall Street, and I just listen to these, they come on TV and they talk about, wow, good values, Apple's down this and that, and Amazon's going to split, and they don't, I think a lot of them just don't realize how quickly the fundamentals can shift and based on what happens on the technicals. So that's where I think, again, this market can be saved. And if it does, we don't take out those recent lows, there's a possibility we have another leg up. But if we go down much more, it's going to trigger, it's going to create a vicious cycle and have a domino effect where you're going to see hedge funds and mutual funds, or mostly hedge funds, blow up. Pension plans start to dump stocks to shore up their losses and cut the bleeding. And margin calls are hit, and that's where you get those quick drops, and then you're going to see a lot of movement in the bond market. And already the bond market's showing you some red flags, is what I just spent the last 15 minutes telling you about, talking about corporate bonds. So we'll wrap it up here, and then if I see any trade ops setups, if you are interested, and drop me a note in the comments section. I'll show you MUB is the municipal bond ETF. I'll show you JNK and HYG, which are the junk bond ETFs, and that's about it. Those are the three big ones I watch. LQD for corporates, all the government bond ETFs, as well as the futures, and then municipals and high yield bonds. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.